exchange, the sentiment of foreign investors. That's usually what we do every time we have Wonuola. Again, as you've mentioned, he is, of course, the head of financial institution sales, global markets at Stanbic IBTC. So we always get the temperature of the fixed income and money market space and FX from Wonuola, because he talks to a lot of big institutional investors, and it's always it's a good time to have him because he's really he's well entrenched in that space. So let's start, I guess, with we had an auction. I think it was a Treasury bill auction. Can you take us through the results and how you're seeing things on that front?
Sure. Thanks, Rotus. So yesterday, the government offered about 38.8 billion of the 91-day bill. They also offered 2.16 billion of the 182-day bill and about 158 billion of the one-year bills. However, they only sold 12.28 billion on the 91-day, or 17.15 billion on the 182-day, and 168 billion on the one-year bills at stop rates of 2.4% on the 91-day bill, 3.79 on the 182-day bill, and 6.07 on the one-year bill. I mean, I think the government sold about 27 billion more than the total that was offered. Obviously, the market had thought yesterday that the one-year bills, especially, were going to close much higher than current levels. And the reason for this is because prior to the auction, the market was short in liquidity, right? Meaning that banks had to, so I think the market was about 700 billion short liquidity, which means that banks had to go look for liquidity from like central bank, or fund themselves. So funding rates were high. So people had thought that the auction was basically going to close much higher than this. However, it basically closed at the same rate, at the same stop rate as our last auction. I mean, that's referring to the one-year bill. So if you see that, I mean, it was even oversubscribed to about 297 billion, right? So everyone had just thought, okay, that because rates were tight, MPR rates currently at 13, inflation currently at 17.71, people had thought that the Treasury bills were supposed to be trending, wider. Even funny enough, the 91 days even closed slightly lower than the previous auction by 9 basis points. In terms of what we expect at the open today, we basically expect that the lost bids would definitely filter into the market. The bulk of the people that actually bid this are the PFAs, basically as asset managers and local banks. So we expect that a lot of these lost bids would definitely feed into the market today. And we might start to see compression in yields of these securities.
Those yields are low, so start seeing compression again in yields that are already low enough. It's not encouraging. But I want to ask you about an article that I saw in Business Day suggesting that Nigeria has been shut out of the Euro bond markets, maybe because rates are high. Talking about ratings on our bonds. What do you make of it? Have we been shut out of the Euro bond market?
Definitely, we have not. We have not been shut out of the Euro bond market. Even if you look at it yesterday, Nigeria basically still redeemed the Euro bonds maturity. So on the diaspora bonds, we redeemed about $300 million, and on the other general bonds, we redeemed about $500 million. So basically, that's what is necessary for you to be, obviously counted as a credible counterparty in that space. I mean, paying your debt on time, paying your coupon payments on time. So if you look at it generally, yes, I agree that the Euro bonds have basically widened in terms of yield, right? So if you look at the Nigerian Euro bonds, they've really moved wider. So that's largely because of what is happening in the world in general EM. general emerging markets. So, I mean, Feds have been hiking rates, and we expect another hike again in July. So that definitely, you start to see people piling into safer security. So there's just that general risk of sentiment. So yes, you see that Nigerian Eurobond yields are double digits. I think the highest there is the Nigerian 2029, which is currently around 13.18%. And okay, and Nigerian 2049s, which is trading at 13.26 in terms of yield. So you see that, I mean, for a dollar investment, it's clear that it's obviously, I mean, for people who are looking to look get better yields, these are probably investing in treasury bills. You can look at like the Nigerian 25s or the Nigerian 23s, which is just about 1 year to maturity. It's even yielding higher than where the treasury bills are closing, right? So yes, Eurobonds are being viable, but obviously that speaks more to the risk of sentiment that we have in Nigeria, in general EM space, than actually Nigerian's credibility. So even if you compare it to our other peers, so look at Ghana, for instance, Ghana's 2027 bonds are as high as 21%, 21.90%. So Nigeria's never near that. Even at the peak of the oil crisis, probably the highest we ever traded was around 15 or 18%, if I can remember correctly. Even Angola, if you look at Angola bonds as well, those ones are also trading in double digits, just over 10%. But Nigeria is not close to that levels at all, because why? We have very healthy reserves. Right. So if you look at our total borrowing versus our reserves, right, that is still makes sense to buy Nigerian bonds. I think Ghana's issue really was because their total borrowing currently exceeds their total reserves. So Nigeria is not close to junk yet. The reason we use that weakening is just because of the general AM sentiment. Even US treasuries are already weaker as we speak.
Okay. Let me quickly, before, I know we have a few minutes left, I want, for people that are listening that want to participate in the fixed income and the money market space, maybe even Euro bonds, I guess going through Stanbic, are there opportunities for listeners to try to invest in those securities and make some money off that?
Sure, yeah. I mean, you can always reach out to any of the Stanbic IBTC branches, right? I would say people who have dollar receivables should invest in Euro bonds if they can. Although the minimum investment there is quite chunky, but I'm sure if they go through our asset management arm, you can basically do lower based investment. And the reason why I said that the investments are high for Euro class settlements, the minimum settlement for most of the bonds is about $200,000. However, if you go to our asset management, I believe you should be able to do it for much lower, because they are able to pull retail investors together, and invest in these bonds. You can also invest in the asset manager also has a Eurobond fund. So it's tracking different Eurobonds, a basket of Eurobonds, instead of just buying one specific Eurobond, and the returns there are also decent, right? Again, like I always tell people, before you invest, check your risk profile and check your obligations, so you can then always just spread out. So if you have dollar obligations, you've got school fees to pay, or you're just hedging against medical, things around that, yes, Eurobond is just a good hedge, because it gives you protection. It gives you protection against any devaluation, right? It also gives you good dollar receivables, basically, so that, because if you're all invested in Naira and you have dollar obligation, you are definitely hit by that risk of devaluation. So yes, Eurobonds is one of those. I'm moving because of where inflation is, and because of where MPR is. It's just basically expected that interest rates will continue to trend wider, right? I think it peaks in the third quarter this year for the local bonds and treasury bills. I think it peaks around the third quarter. So, if you, like I always say, it just depends on your view. But yes, if you still want to have it wait for a distant yield pick up, it'd be good to pile into bonds around the third. third quarter.
Okay. Great stuff. Great stuff. Great stuff. Great stuff. Can you quickly on FX? I know we've only got a couple minutes to go. Can you just give us your feel of the FX situation? Because we've seen where the parallel market rate is, and I know that there might be repatriation issues with some investors. How are you seeing things on the FX foreign exchange side for Nigeria?
Yeah, I mean, it's really the same story, right? And I don't think this changes till after elections. I mean, CBN is just adopting an orderly exit strategy, whereby they've just been offering targeted sectoral sectors, right? So they offer to FPIs on a weekly basis, about $50 million generally. They offer to manufacturers, for basically trade, for trade investments, they offer that twice a month as well. So, I mean, if you really look at things, CBN remains the major supplier of liquidity in the INE window, that's the investors and exporters window. After that, you see maybe multinationals as well, who basically also sell dollars, but a lot of them utilize those dollars for their own resource. So it's really, really the same story. We have that wide dislocation whereby interbank is currently, hovering around 418 and 422. And I mean, the investors are basically getting interventions around 444 and 453 rates. And then you have the black market trading over 600. So obviously, because we have that wide dislocation, I mean, you start to see a lot of people maybe arbitraging that. And obviously, it doesn't stir any investor confidence because, I mean, why would I sell dollars around 418 if, parallel market rates are that wide? Right. I mean, we still see a few guys still do that, but obviously, unless CBN sort of like either unify the rates or at least reduce the spreads within those markets, I don't think anything changes from a foreign investor's perspective. We still have a lot of backlog demand that needs to be cleared. Like I said, CBN is still offering dollars to investors, but it's not basically enough to clear that demand. I guess maybe when things like the refinery kicks in, Nigerian export, because CBN's body language now is really more targeted at exporters, looking for ways to promote exports, so that we can basically, accrue more to our reserves. I mean, that's been dwindling, even though we see high oil price. I mean, currently the reserves about $38.92 billion. So yeah, I mean, I guess CBN was also looking at the whole macroeconomic framework ahead of the elections. So I doubt they do anything drastic to change the way things are. Maybe we'll continue to see those gradual depreciations. But until those rates are, I mean, not necessarily unified, but the spreads are tighter, I don't expect much to change in the current FX market.
All right, just before we go, a message in from Otunuga says, some of my friends invested in Ghana 2061 bonds. What risk are they carrying on that particular instrument?
Well, the only risk is that Ghana defaults, right? That's the major, I mean, that's the risk you carry on any investment. You carry the risk of the issuer. Now, for that risk to crystallize, I think a lot has to happen because the way the Eurobonds actually work, once it's defaulted on one security, then there's usually a cross-default trigger across all maturities. I don't think Ghana defaults. I think they'll rather go into an IMF program before that even happens. And if you see all the policies they've been making, it's tending towards IMF type policies. So, and they're very closely in talks with IMF. So I believe that before any default, it's really more around them going to an IMF program to at least weather the storm.
We need to go now. Thank you very much, Wonuola Konbi, for being a part of the show. And Rotus, as usual, thank you very much. Let's keep the conversation going on Twitter. It's at Smooth981FM and tag Rotan Quote into the conversation. Have a good morning.
Thanks, guys.
Thank you. Thanks, guys.